The University of Michigan Consumer Sentiment Index just hit its lowest reading in recorded history. Not the lowest since the financial crisis. Not the lowest since COVID. The lowest ever. And the Nasdaq just posted its 8th consecutive session of gains, the longest winning streak since September 2025. Both of those things happened on the same day. That is not a typo. March CPI came in at 3.3% year-over-year, with a monthly print of 0.9%, the sharpest monthly rise since June 2022. Iran war energy costs drove the surge. Oil prices are elevated, gasoline is expensive, and Americans feel it. Yet the S&P 500 ended the week up 3.56%. The Nasdaq Composite closed at 22,902 on Friday. CoreWeave jumped 10.87% on a multi-year AI cloud deal with Anthropic. AMD gained 4%. Broadcom climbed 5%. Stocks and sentiment are moving in opposite directions with unusual force. One of them has to be wrong, or something stranger is happening. Consumer sentiment measures how households feel about their personal finances and the economy. Stock markets measure something else: the discounted present value of corporate earnings, weighted by institutional capital flows. Those two things have always diverged. But the divergence today has a specific structure worth unpacking. The Iran war created an asymmetric shock. Energy costs surged. That hits consumer wallets directly and immediately. But the same war that crushed sentiment also triggered a ceasefire rally this week. On Wednesday, stocks soared when Trump suspended attacks on Iran for 2 weeks. The Dow posted its best single session since April 2025. That rally was not driven by consumer optimism. It was driven by institutional repositioning. Funds that had been defensively positioned rotating back into risk assets on the ceasefire signal. Meanwhile, the underlying AI infrastructure build-out continued regardless of geopolitics. Anthropic signed a multi-year cloud deal with CoreWeave. Amazon's CEO Andy Jassy published a shareholder letter reaffirming AWS AI growth. These are not consumer sentiment stories. These are enterprise capital allocation stories. Big tech companies are still spending. Hyperscaler CapEx commitments haven't wavered. There is also a mechanical factor. The Nasdaq 100 is on its 8th consecutive day of gains. Momentum following strategies, systematic trend funds, risk parity allocations, options, delta hedging, amplify moves once a trend is established. Retail participation is limited. The survey respondents complaining about grocery prices and gas costs are not the marginal buyers in the Nasdaq. Core CPI, which excludes food and energy, came in at 2.6% annually, below estimates. The Fed is watching core. Wall Street is watching core. Consumer sentiment is watching the gas station price board. Those are different data feeds, producing different emotional outputs. Snowflake dropped 8.57% on AI disruption fears. ServiceNow fell sharply after a UBS downgrade. The rally is not uniform. It has a very specific fingerprint. AI infrastructure names are leading. Consumer-facing names are lagging. Tesla logged its 8th consecutive week of losses, down 22.4% year-to-date, while the Nasdaq surged. The divergence inside the index is as important as the index level itself. The condition that breaks this logic: if the ceasefire collapses, or if Q1 earnings confirm that consumer weakness is feeding through into corporate revenues, the institutional rotation unwinds. Sentiment surveys become a leading indicator, not a lagging one. The weight of evidence points toward continuation of the AI infrastructure rally in the near term, but only if two conditions hold. First, the Iran ceasefire extends beyond the 2-week window. Second, Q1 earnings season, which begins in earnest next week, does not reveal that consumer sentiment collapse has already damaged corporate top lines. Those are not trivial conditions. If earnings confirm revenue stress, particularly in consumer discretionary, retail, and advertising, sentiment stops being a divergent story and starts being a preview. Historical precedent is uncomfortable here. In 2022, consumer sentiment hit multi-decade lows in June. The S&P 500 bottomed in October. The lag was 4 months. Markets ignored sentiment until they couldn't. If the ceasefire holds and earnings beat, the Nasdaq 8-day streak extends, and institutional positioning builds further. Systematic funds add exposure. AI CapEx stories remain insulated from consumer stress. If either condition breaks, ceasefire collapses, or earnings disappoint, the rotation reverses fast. The same funds that bought the ceasefire rally sell the breach. That would make the sentiment number not a curiosity, but a signal that arrived early. The benchmark to watch. Next week's bank earnings kick off Q1 season. JP Morgan, Wells Fargo, and Goldman Sachs report Friday, April 17th. Their consumer banking commentary, loan delinquencies, credit card spending trends, deposit outflows, will be the first hard data point that either validates or refutes the sentiment collapse. If delinquencies are rising and card spending is decelerating, the divergence narrows, and not in the market's favor. The final tension. The Nasdaq hit its longest win streak in 7 months on the same day Americans registered the worst outlook in survey history. One of those is a trailing indicator. The question is which one?